The breaking point came in 1971. Countries began demanding physical gold in exchange for dollars. The US realized it couldn't deliver. So President Richard Nixon did something unprecedented. He shut the gold window. The dollar and every currency tied to it became a pure fiat instrument. Money became just numbers. Debt became endless. And growth became debt. This wasn't a small policy change. This was the moment money stopped being a store of value and became a system of liabilities and promises. Once gold was gone, there was nothing left to limit how fast money and therefore debt could expand. Central banks took control. Commercial banks multiplied credit. Governments spent more, borrowed more, and justified it as economic stimulus. But here's the twist. Debt didn't just grow, it began to grow faster than the economy itself. Why? Because the new financial system required it. If debt stopped growing, the economy would stall. If debt shrank, the economy would collapse. This wasn't a bug, it had become the engine. From the 1980s forward, something remarkable happened. Banks weren't just lending money, they were creating it in the form of credit. Governments weren't just borrowing, they were building entire economies on future spending. Consumers weren't just buying, they were financing lifestyles through credit cards, mortgages, and loans. The world moved from earn first, spend later to borrow now, pay later, maybe never. Debt became the fuel of everything. Housing markets, stock markets, government budgets, corporate expansion, consumer lifestyles, international trade. Every part of the modern economy became tied to borrowed money, and once the world got addicted to cheap credit, there was no going back. The system now needed more lending, more stimulus, lower interest rates, bigger deficits, because every time growth slowed, governments and central banks pulled the same lever, add more debt. But the more they added, the more the system required, like a machine that eats faster as it grows. By the early 2000s, debt wasn't rising with growth, it was far outpacing it. Then came 2008, the predictable result of decades of credit expansion. Households couldn't repay, banks panicked, markets collapsed. In theory, this should have been the moment the world reset. A chance to rebuild a sustainable system. Instead, the opposite happened. Governments printed more, banks lent more, central banks slashed rates to zero, debt skyrocketed, and the economy became even more dependent on borrowing than before. Think about that. The solution to a debt crisis was more. The machine had no reverse gear. As debt expanded faster than growth, side effects emerged, ones we still feel today. 1. Asset prices detached from reality. Houses, stocks, even basic goods inflated not because of demand, but because of overflowing credit. 2. Inequality exploded. Those closest to the credit system, banks, corporations, investors, gained the most. Everyone else fell behind. 3. Governments became stuck. They could no longer fund themselves without borrowing. Debt service became one of their largest expenses. 4. Economic cycles became artificial. Booms were created by cheap credit. Busts were fixed by lowering rates and expanding debt again. 5. Growth became an illusion. Much of what we call growth today is actually debt-powered spending, not real productivity. The global economy didn't just rely on debt, it became inseparable from it. Over the years, leaders proposed solutions: austerity, fiscal discipline, higher taxes, monetary tightening, balanced budgets. None of them worked. Not because the ideas were bad, but because the system itself can't operate without expanding debt. Cut debt too quickly, markets crash, businesses fold, governments panic, unemployment soars. So every attempt to slow borrowing eventually reverses, and the debt machine continues. The truth is simple: when money creation is tied to credit, the system becomes addicted to credit. There's no mathematical way for debt to shrink without shrinking the money supply itself. This is why every solution becomes another patch, another round of printing, another expansion of debt. Narrator VO. Fast forward to today. Global debt is now over $300 trillion, 3 times the size of the entire world economy. Governments borrow to pay old debts, corporations borrow to buy back stocks, consumers borrow to maintain living standards, banks borrow from central banks, who create money out of nothing. Every sector is locked in the same loop, and central banks are trapped. Raise interest rates, governments struggle to pay their debts. Lower interest rates, debt grows even faster. The system has entered a phase where every solution creates a bigger future problem. We've seen this pattern before. Latin American debt crises, Japan's lost decades, 2008 global financial meltdown, European sovereign debt crisis, pandemic stimulus wave. Different countries, different years, same cause, debt expanding faster than growth. And unless the underlying structure changes, the pattern will repeat again. Takeaway number 1. The system needs debt to survive. Modern money is created through borrowing. If debt stops growing, the economy stops functioning. Takeaway number 2. Debt expands faster than growth by design.